Ladies and gentlemen, good day. You're highly welcome to the Dicalo Consulting YouTube channel. In this session, you can learn accounting free of charge at no cost. All we request from you is that you should always subscribe to our channel and make comments and like our videos, so that when we upload new videos you can be notified. At the moment we'll be studying more about efficiency ratios. Ratio analysis is very important aspect in accounting, which enables us to be able to analyze and evaluate the performance and future of a company given a certain set of data. At this moment we're going to be looking at what we call efficiency ratios, and at the level of efficiency ratios we'll be trying to analyze the financial statements of this Dicalo Consulting Group for the past 5 financial periods, and then from there we're able to make recommendations and evaluate and see whether the company is performing well or not. Our first efficiency ratio here would be what we call the inventory turnover. The inventory turnover is simply a ratio which is used in evaluating the extent how long it takes a company to convert your inventory to sales. At this level, we'll simply divide the cost of sales by the value of their inventory. So from here, we go to our income statement. We take the value of cost of sales. Our cost of sales will be taken from the income statement. We have our cost of sales. You divide that by the value of the inventory in the balance sheet. You go inventory should be in under current assets. So current inventory here is this. We equally have what we call inventory days. The inventory days, you're simply trying to evaluate how long to calculate the duration that it takes for you to convert your inventory to sales. And this formula, you simply take what your inventory and multiply by the number of days in a year, and then you divide by what? By the cost of sales. So here we're going to be taking inventory here is this. You divide that by the cost of sales. This is our cost of sales. All these multiplied, all these multiplied by the number of days in a year, which is 365. Then again we move down. We have the receivables turnover. The receivables turnover will be expressing your trade receivables as a percentage of credit sales or sales. In this situation, we have been given the value of the sales, so you take the value of the sales revenue, and you divide that by the value of trade receivables, which should be under current assets. Current asset receivable here. We go down again. We have the value of receivable days. You want to evaluate how long it takes for you to collect money from customers from the date when you actually initiate sales. You'll be taking your receivables divided by sales and multiply by the number of days in a year. We go to our balance sheet or assume financial position. We have our receivables divided by the sales. Receivables by sales, because we have actually made an year, and then you multiply all by the number of days, multiply by 365 days. Then we equally have what we call payables turnover. It actually calculates the duration, how long it takes a company to be able to pay its suppliers of goods and services or raw materials. So we're taking cost of sales, divided by the value of our payables. Payables will be taken from the balance sheet, and the value of our payables here is this. Then we have payable days. You're trying to calculate the number of days that it takes for you to be able to process payment to suppliers whenever you buy goods from them. So you take the value of payables divided by cost of sales and multiply by the number of days, number of cost of sales. Payables days, you'll be taking the value of your Payables,